Ladies and gentlemen of the crypto space, we're live on a Friday, April 15th at 12:30 p.m. I'm going to try and keep it short and sweet today. I think I have until 1 p.m., but it's an important topic to talk about. Obviously, we have a great deal of experience from past market cycles, including 2020, 2021, and obviously further back into 2016, 2017, leading into the end of 2018 and all of 2019 as bearishness. So what can we draw from all this experience? We draw much more experience, obviously, from the most recent market cycle. But we know from historic market cycles that there's bullishness, then there's exuberance, then there's complacency, and that's that historic chart that everyone looks at, and return to normal and all that. And that's really where we are. We're at the complacency stage of market cycles where everyone thinks it's going to stabilize and it's a setup before bullishness resumes. But bullishness and that type of appreciative directionality is truly a manifestation of a much larger picture, and that's exactly why we look at the bond market. We really think of OTC derivatives and we think of the Eurodollar market, and that's where Jeff Snyder talks about it being a disinflationary global currency system. And that really just highlights from a reductionist standpoint how much pressure is on these markets. The last place to look for the direction of the crypto space and the stock market, for that matter, is the crypto space and the stock market. It all operates in cycles of a much larger structure. And that structure really is probably best observed in the bond markets because we don't really have, very fine-grained data on OTC derivatives, and certainly don't have very fine-grained data on the Eurodollar markets. But we could see it because the bond markets are very visible, and truly the bond markets are very large, but they're also a manifestation, or they're directly influenced by OTC derivatives because it's the primary collateral for those markets, and so on and so forth. Eurodollar market is very shadowy, backroom type stuff. So we always see its knock-on effects in many regards, but it's clearly the gorilla in the room that pushes these markets around. So the directionality of the markets persist until capitulation, um, and we haven't had capitulation. So really the question is, what's the next step for the 2022 market, which ultimately is either 2000 or 2008, or maybe a 2020 if you want to, really get hopeful. I am a fan of ripping band-aids. So if we have a very big risk-off event and everything completely collapses, that's when you get exactly what happened in 2020. You have federal intervention, and then you get a very immediate resumption of appreciative directionality. I guess really that train of thought leads me to be able to talk about Fed narrative. And Fed narrative really is they're pushing for a soft landing, but that doesn't make any sense considering the scale and scope of the market, of how perverted it's become. And the soft landing would be 2000 style, where it took 10 years, 10 years for the markets to get back to where they were, for Amazon to get back to where it was. Does that make any sense? Does that make any sense in this kind of market? How perverted it's gotten? It's not even remotely conceivable. So maybe have a 2008. What happened there? A year or two. There's federal intervention, obviously, in '08, and it took a couple years for things to really start to stabilize. And what happened in 2020? 3 months. Took 3 months to get back to really where things were. It was a vertical liftoff from the bottom. Massive, massive federal intervention. And the question, really circulating is, what kind of bearish market can we expect? There's going to be a rapid deterioration. It's going to be an orderly deterioration. I mean, that's obviously the propaganda narrative that the Fed regurgitates, but that doesn't seem rational. It seems like it's just pure propaganda, and that's a talking point that they really need to say. They need to say what they want to occur, even though everyone that understands how perverted the markets are, that they can't occur. So, bottom line is, I don't think they're going to be reactionary. Reactionary entails they stimulate the economy prior to some sort of capitulation event. That makes no sense, because that means they have to abandon their propaganda and admit that they did a policy error. And how often does that occur? I going to admit they did a policy error? That'd be fantasy land in so many regards. So all signs point to it being a reactionary intervention. Probably mostly akin to 2020, where it's just massive, and they really need to keep things so stimulated that they don't completely implode from deflation. Where there's a recursive implosion, a recursive liquidation of positions, and where like credit market sees up, and enterprise is really just going to completely implode across the entire nation, if not the entire world. And that's why they did exactly what they did in 2020. So that's probably where my narrative points me to. That we're going to have a capitulation event, some sort of liquidity event, some sort of the credit market's going to freeze. And I mean, that's really what led up to 2020. It was 2019. 2020 didn't happen because of 2020. 2020 was a manifestation of the repo crisis in 2019, where bank credit froze. It was failing. The banking system failed in September of 2019, and federal intervention propped it up for another couple of months until the market decided to have a seizure, and then all hell broke loose. So that's probably where we are in the markets. Doesn't make sense for it to be a 2000 orderly, depreciative environment, and even 2008 seems a little bit mm, calm. Can you believe that? 2008 seems calm, like a likely doesn't make any sense. How can we have a 2008 that's relatively calm compared to what occurred in 2020? So, the market is so perverted right now that it makes sense for the next liquidity event to be more exacerbated than 2020, more pronounced, more volatile. The a credit market freeze in one of the more critical components of the financial system, and it's just going to be even more pronounced because it's much larger. It's just even more inflated. Just it's gross. It's the only word applicable is perverted. So what does that mean? We understand where we are in the market, and we've talked over the last couple of weeks about portfolio structure and stable coins, obviously, and risk assets, and how we balance them. And we talked about the sliding scale of risk on, risk off of stablecoins versus risk assets. And obviously, this is not a market to be heavily exposed to the volatile assets because you need a portfolio filled with less volatile assets such that the portfolio is in balance. And your goal is to have a portfolio that is well balanced. Not appreciating, but well balanced, because a portfolio that's well balanced means you're respecting the portfolio. And when we respect the portfolio is going to respect you. So, what could we probably expect? We could probably expect a well structured portfolio to lose less dollar denominated value than a poorly structured portfolio. So, you don't assess in this type of market a portfolio based on growth and appreciation and it making money. We assess a portfolio's health and how well structured it is by how little the portfolio loses value. So, what's pertinent and going through my mind with regard to a portfolio other than it losing as least valuable value as possible? That the portfolio is primarily allocated to assets that will persist. So, out of 2016, 2017, very few assets remain. What an extraordinary reality. But I don't think that'll be the case this time. I think we're going to have an entire industry remain. We have basically financial rails and financial systems and the emergence of currencies that are not sovereign currencies, but they're currencies. Clearly, they're currencies that have properties of equities and commodities and all the associated fund derivatives that come along with it, like money markets and debt markets, so on and so forth. So we have truly systemic infrastructure. So that is probably the biggest thing I think of. A well structured portfolio is going to depreciate less than a poorly structured portfolio. And the sliding scale should be, I would say, probably either 60-40 or depending on your risk tolerance, maybe 50-50. After tax obligations, I'm probably about 40-60, 40% cash, 60% exposure to volatile assets. But one, it's a requirement because the volatile assets that I have remaining exposure to are all locked positions, either vote locked with convex that have an unlocked period that's relatively soon, or very long-term vote lock positions like a VE curve or a Frax or a Chi or whatever vote lock positions I have, they're really vote lock because I'm a 4-year lock core. My vote lock positions, when I have a 4-year option, I take it. So those positions are not on the table for liquidation, and basically the portfolio right now is completely liquidated of all positions other than those. I have nothing that I cannot sell because this is a market where if you have something you can sell, you should probably sell it until you get to a risk on, risk off portfolio balance that you're comfortable with. If you're 60% cash and 40% assets, if those 40% of assets go to zero, are you comfortable with that amount of cash? And that is a great way to assess how well the portfolio is going to respect your need to be comfortable and your capacity to sleep at night. Now, during all of this, as you're structuring the portfolio and assessing the state of the market, it's preparation for 2020 and 2023, which means you want exposure to assets, as we've talked, that pay you, assets that are systemically meaningful, that contribute to a robust capacity for capital to flow through the crypto space, because those are the assets that are going to have longevity and they're going to have moats and they're going to have systemic significance, so to speak. And it's not like I'm going to bring up new assets today. We know all the assets. You guys do your due diligence. You know what assets to look at, and you know new assets are going to be out on the risk curve. It's going to be a heck of a market right now for a new asset to launch. There's going to be scavengers everywhere thinking the same way I'm thinking. Going to sell anything you can. And you're going to position yourself in assets that have structural significance that will persist into the next market cycle, the next period of irrational exuberance. And which are the ones that are going to outperform the most? Sure, you could come across a relatively new asset that's out on the risk curve and it could significantly outperform, and you could get your 10,000%, 100x on the money ROI. But most of my content, and I know most of our viewers are veterans from at least 2020, maybe late 2021, early 2022 has been basically a bear market, so it has a relatively small amount of persons getting in, um, at least to the DeFi space. So a lot of the content must be geared towards people that have been here. So in order to do that, we're talking about really what I think is the most important thing for 2022. What two things is preservation of capital, which is a manifestation of a well-structured portfolio. I'm 40% cash, 60% volatile assets. So if you want to preserve the capital for the next bullish cycle, so you could buy, CVX at whatever capitulation is to the downside, like a ridiculous bearish wick down to 14 or something, you'll be able to buy it at 14. And then what happens when you see all those liquidity cascades? You see the giant wick. You'll have a daily wick of $10 on the asset where it rips up 100%. Or stuff like Caleb's saying, like Deuce, that's really picked up, and Lafa has some very big ideas with Forex, which he's probably about to unleash onto solidly. He showed us the ruble the other day. This is powerful tech. Now, obviously, Deuce is a bit more out on the risk curve compared to curve or convex. And as you go onto the risk curve, you have the potential for asymmetric gains and also asymmetric losses, for that matter. And that just goes into position sizing and that type of consideration. So obviously, thinking about 2022, it's about capital preservation, risk management, so that you have capital to go into the next cycle after a capitulation event. And you obviously do that with stablecoins. The awesome things about 2022 is that stablecoins are productive, and your volatile assets, your vote locked assets, are all productive in 2022. So you don't have a stagnant portfolio, and we don't need to rely on just appreciation uh, price action, appreciation, and capital gains in order to realize a return. So what's happening in the DeFi space is a capacity for the general public to start structuring their capital like the wealthy. Like Buffett stacks like 5 billion worth of a stock and is producing $100 million worth of dividends a year type stuff. Because he's not getting the dividend rate, he's getting like a partner rate, like he owns the business. So that's really what's occurring in 2020. You're starting to think in terms of asset ownership and the revenue streams that they produce. So, we're dealing with tax season right now, and that's given me a lot of encouragement to handle taxes better. It's imperative that next year you did better this year, and most of the burden associated with tax season is excessive trading, excessive interaction with the markets, attempting to realize outperformance in the form of capital gains, which is necessary for the smaller portfolio, and I could appreciate that. So you're going to have to deal next year with the shit that we dealt with in 2021 and 2022, and then you'll get to be able to have the type of conversation where you're structuring your portfolio to not focus on capital gains, but more so recurring revenue streams where 30, 40, 50% return on capital is significant and meaningful, that you don't have to expose yourself to the search for yield or outperformance, where you can relax knowing that even during bearish market conditions, your volatile assets are producing income that you could live off of, and your stable coins are also producing income that you could live off of, and all of that is merely reduces to making sure that the portfolio is preserving as much capital as possible during this depreciative period of time while being functional and also preparing for the upcoming market cycles. Quite fascinating. It's been a heck of a start to 2022. I'm sure there's going to be much more craziness that we're going to be exposed to, especially considering the way the 10-year chart looks right now. There's a big 15-minute opening monologue, but the 10-year looks positioned for something extraordinary, either a massive, massive move to the upside in yields, or yields could completely collapse. Based on historic precedent, yields could completely collapse here, and we have a complete risk-off event. If bonds start ripping to the upside, that creates momentum, and then bond buying begets bond buying, and that creates the air of a risk-off event, and equities completely collapses, and then the Fed's like, oh my God, we have no industry left in the country. And then they step in and try and stabilize market liquidity. Let me answer some of you guys' questions, see if I can help you guys in these trying times, and that's what we'll do for today. Joe's in the house, CJA, hello, stuff, my friend. Darky Gus, Darkin, my man. Happy Friday. Fly Me High, no any chance of giving dummies post-mortem on why your Solly narrative was invalidated. So ultimately, I'm a core narrative kind of guy, which means solidly bribes are broken, um, emission schedule didn't live up to expectations, dilution just it's not protected. And basically the core tenets of VE33 tokenomics documentation was not manifested, and it is what it is. Now, obviously, 0x DAO and Deuce are stepping in to use solidly, and it is a functional platform, and the bribes are working because if you're allocated on 0x DAO to Day Deuce, Deuce is paying, and Deuce is using solidly for forex market functionality, so it's meaningful. Uh, I don't. I would never have it as a large percent of the portfolio in these types of market conditions. But if you have a vote lock on 0x DAO, it is what it is. You can't do anything about it. And that's the type of interesting result that occurs from a leap of faith taking a long-term vote lock. You're gonna be there no matter what. You're gonna experience depreciation if it occurs, and if the protocol survives and things are built on it, it's gonna be a part of the portfolio that you're gonna appreciate that you took the leap of faith in a year or two. Um, and that's why I like these 4-year types of lock positions. Either it's something big or it fizzles and evaporates into nothingness. And more often than not, it's going to be something meaningful. I mean, look at VE Curve coming out swinging with 40 something percent ROI. That's wild. For a long time we thought V curve was going to be the rat race, where you have to get more and more of it, and you're talking about the end result being revenue just from transaction fees. But it turns out these bribes going to V curve is about 40-50% on the money. So V curve pays just as much as VLCVX right now. That's crazy. So that's food for thought. I'm quite excited for the future of VE Curve, Roblox CVX. I think Qidao is going to be a big deal. Obviously, VEFXS is going to be. There's already bribes. You got Hidden Hand. You got this other system, Pitch Money, and obviously Convex is going to get into the mix with Frax significantly more. There's going to be LP positions available, incentivized by Frax, because obviously Frax has LP positions available on its site. And I recently threw some cash into like a 3-year lock on Frax, producing 30-something% return on the money. And those will be exposed in a more fungible way, or at least accessible way, because on Frax you need a lock for a period of time in order to access multiples. But maybe you could access multiples from Convex without having to lock cash up. So I think Frax is probably one of the strongest narratives in the crypto space. There was a nice article, a nice tweet storm comparing Frax and Luna the other day, that they started in the opposite, but they're going to end in the same destination. Maybe I should try and track that down. I want to retweet that again. So I really like that one. But it's big narratives. This is big stuff. And we're going to have systemic volatility. So we're going to see how well these protocols handle the most harshest of market conditions, where collateral can completely evaporate in price point. And we're going to see how well the lendiness takes over, where the faith and belief in these assets doing what they're supposed to be doing carries their existence into the future. And Curve obviously is the most incredible facilitator of stablecoin peg. You could have a completely imbalanced pool, and the stablecoin is basically still on peg. It's actually quite remarkable. The empirical data we have from MIM, it's basically on peg, and the pools are completely imbalanced. That's absolutely extraordinary. Harsho, hello. One curious view. You also need to be careful of tax squeeze in these markets, creating a taxable event, and then the asset price drop, leaving a shortfall for your tax obligation. Well, clearly, you need to be aware of how much taxes you owe. Do not get into a situation where you owe more taxes than the capital you have. Please. That's imperative. Could you give a high-level explanation of Deuce? No, I'm not too into Deuce. I know Deuce. I know I've talked to Lafa. I like what they're doing. And I think Joe probably said it. It's a farm token. It's a governance asset. I know the protocol has Forex options. I'm just not exposed to it because I'm not going out on the risk curve at all. The vast majority of my portfolio is Votelock, CVX, and VEFXS. And frankly, FPIS is the largest airdrop in history. It was literally airdropped to me at 4% of the portfolio. That's absolutely wild. So, Noah, can you please give me the strength to sell my altcoin position with 50% loss for stablecoin? I know the feeling you have, and clearly the sentiment is that you should have sold it sooner. You, in these market conditions, I would say it is more likely the case than less that the sale of it would be good, meaning markets will more likely than less go down rather than up. The hopium comes from looking at the technicals of crypto charts. Bitcoin does look good. Even the on-chain data looks good. Where it's, Willy Woo talks about on-chain saying it's reset, funding has been reset. Great, groovy, grand. But the macro conditions, when you look at the bond market and you look at currency, I mean, look at this dollar chart. This is just wild. The amount of pressure on Europe and Japan. So DXY is predominantly dollars versus euros and yen. So the amount of pressure on yen and euros to produce a currency chart like this is extraordinary, especially it's got gaps in it. This thing is wild. So there's a lot of pressure on the financial markets, and I gotta peer through the madness of the exuberance and the bullishness in the crypto space. People looking at these bullish crypto charts and saying it's holding support, it's holding support, but they're not the charts that matter. What matters is this chart, which is a knock-on effect of this chart, and this is a knock-on effect of OTC derivatives, and OTC derivatives is small compared to the shadow banking of the euro dollar system. So those are the markets that push around the very markets that we're interested in. I can't get behind the reality that probably anything that can be sold should be sold. But I also like the idea of just, it's good to have long-term positions, and those long-term positions, I would say, for me at this point, is not Ethereum, is not Bitcoin. It's financial instruments contributing to financial infrastructure that has systemic importance and moats that are entrenched, that really are meaningful conceptually, systemically. They are analogs to traditional financial structures, except they're disintermediated. What a wild system that we're able to interact with. Hey Noah, how are you doing? Live in the house, always a pleasure. It is the weekend. It is Easter. I got friends and family coming over. It's going to be a good weekend. Any thoughts on the recent Citadel DAO proposal to launch the BTC Treasury and partner with Frax and Curve? Yeah, it's as big as it gets. I'm quite excited about it, and clearly, you can have bullish outperformance in the most bearish of markets. So I've paid the tax obligations. I have my cash left over. I want to preserve it to the best of my abilities, and I will hesitate ferociously to deploy any capital into a scavenger's market. But on the radar is three protocols that catch my fancy the most for what to do with stablecoins. Citadel's on there, but I'm very, very hesitant to deploy capital to volatile assets, even a new potentially vote lock position, generally because I know how productive stablecoins are going to be with three choices: catalog finance, Bancor V3. I'm curious how Stargate evolves, and in worst case, literally the Frax LP positions on convex finance, and even just the Frax LP positions on Frax. They're just really incredible when you can get 20, 30% on stable coins. Why the hell are we gambling when you can get 30% return on your money? Because then you could actually work, you could outperform inflation, you could save, you get revenue streams if you have enough capital. It's quite extraordinary, the opportunities that are available without trying to turn $1,000 into $1,000,000. If you actually engage with these markets rationally, prudently, in a risk-considerate fashion, they're sustainable. You could sustainably manage your money in a risk considerate fashion. You could run a risk desk. You could run all the traditional processes and procedures that family offices do to maintain the wealth of the largest market actors. And you don't have to do it with a half a billion, a billion, $10 billion. You could do it with thousands and thousands of dollars, and it works because you now have access to the processes and the systems that historically were only accessible to accredited investors. When you're buying these altcoins, you're buying startups, you're buying VC shit, you're buying stuff that historically was only available to accredited investors, VC firms, large market actors. You couldn't do this historically, and this is brand new. It occurred in 16 and 17, but it was bullshit. It was vaporware. But now you're dealing with business operations. You're dealing with these startups just like they were in 16 and 17, except they weren't just ICOs. They weren't just venture capital raises. These are literally businesses with cash flow, assets on the balance sheet, reserves that contribute to monetary velocity, that manifest currency, that have extraordinary monetary policy. This is so different than the way it was historically. So you really need to dig in to the way things have operated for family offices, their rules and procedures, and the concept of risk management and capital preservation during bearish times, and and venture capital during bullish times. When I say venture capital during bullish times, is basically just the stuff that we always talk about is what do you buy? And this is all VC. You're a VC. If you're in DeFi, you are a venture capitalist. This is not the stock market. This is not some bullshit. You're getting into a stock that just launched and it's after the investors, it's after everyone takes a cut. You're getting into a lot of crypto assets after there's a lot of money to be made for the folks that seed crypto protocols, but after those folks get diluted or they sell their share, you have stuff like really where Convex is right now and Curve is right now. There's an emission schedule and it's just a choice whether to buy a large position or a small position. And believe me, there's a lot of VCs that are contemplating to get large positions in Curve and CVX. And they're not new protocols, but that's really the expression of a maturation of the market. You don't have to go for the stuff that's all the way out on the risk curve anymore. You don't, in my opinion. And I think that's important. So, Nifty, I'm very excited about Citadel. I'm even more excited about Frax, FPIS, as well as what's going to come from Convex's really more tighter integration of Frax. Found the place to put my where it's been around 60 to 90%. I saw that as well. I saw that thread where my was talking about its stablecoin yield opportunities. You could go out on the risk curve, and it's not for me. But for me, my comfortability with stablecoins has to be maximum preservation, USDC, GUSD. But my man, I got my cheat out position, so it's all good. I think with the Celsius, the tight Celsius integration, separate and apart from Celsius blocking US users, that's another story. It's a global operation. So Celsius working with Qidao, I think in the next couple of years, that's a solid bet. Yep, going to do better. Learned a lot. Cap gains, risk minimization is a good foundation for long-term growth. Sporos, you get it, my man. We've been around the block before. Trader Z, if I had a productive asset, would you turn that asset into stables or continue compounding? In this market, I would turn it into stables. Sell everything and anything you can. And vote lock stuff you can't sell. So now you're just thinking, should I lock something up and force myself to hold, or can I sell for stable? So if you have a capacity to sell, I would sell. If I had more assets that weren't locked, I would be selling more and carving out more stablecoin portfolio positioning. You're very welcome. As a minnow in the crypto space doing capital gains taxes today, I look forward to playing the cash flow game instead. Capital gains is an absolute tragedy. Tax preparation is a failure. It is impossible. It's completely impossible to accurately report tax obligations unless you're operating just on Coinbase or just on Gemini. Working in DeFi with the smart contracts, it's technologically impossible for any of the software to give a completely accurate depiction of all taxable events. It's an absolute mess. So I don't have much more detail to provide, but I think you do your best. Obviously, token tax, you could pay $2,500 and then they'll do their granular reconciliation. So if you have a large tax obligation, it's probably best to pony up the bucks for token tax. And then you're passing culpability onto their accountants that sign off on it. You're still liable if an audit reveals that any additional capital is due. But the culpability is passed, which I think is meaningful. You get someone to sign off on your taxes if you can. Good afternoon. Hey, Dan, how are you? How will four pool bribes be structured? Probably comparable to the other bribes. I think between Curve, Convex, Frax, Luna, I think it's just going to be wild in a year with what's going on in Convex. I think the amount of capital that's going to be thrown at bribes, so anyone that has a vote lock position, I think it's just going to be absolutely fascinating what emerges from all of this. So if you can preserve capital and you still have, 25, 30% of your all-time high remaining in a year and the market turns bullish, that 30%, it's going to be wild times ahead. So don't fret too much about depreciation. Don't fret at all about a capitulation to the downside, because if anything remains, Any like multiples of gains remain from your original 2020 positioning before all this insanity began, the next multiples are going to be extraordinary. It's like, Bitcoin ripping from 200 to 500, 500 to 1,000, collapsing, and now it's at 40 grand. So the multiples in the altcoin space now with the DeFi systems are going to be quite extraordinary. No opinion on Tribe or Fay. I got to wrap this up in a second, guys. BTC long-term time frame doesn't even look that bad yet, honestly, until we break below those lows we made earlier this year. Yeah, the problem is, yep, hopium. The chart for Bitcoin is irrelevant. It's the chart for currencies, bonds, and we don't have charts for derivatives, and we have some stuff from euro dollars. But really, the bond market, why I've had this chart up the entire time. This movement on the bond market is absolutely wild. It doesn't exist. This is not normal. So something wild is going on with global collateral. Exactly how Jeff Snyder talks. Ethan in the house, a pleasure. Silo Finance, I've heard of it. It's not on my radar right now. I just have no patience or time to go out on the risk curve. As always, thank you for streaming, Noah, and thank you for being you. Yeah, I know I do things a little bit differently around these parks because we can do better. 39 people in the stream, 13 likes. We can do better. We're going to wrap up the stream in a second. Do you have any views on the market? Commentators calling for 10K gold? No. No, I don't want the multiples. I don't want multiples on principal anymore. Now I just want 40% of the money. Why didn't they make a 5 pool, including MIM? I can't answer that. That's complex. That's politics. Crypto politics. Friday, April 15th, 1:06 p.m. As always, I thank you all for joining me. I love this. I love you guys just as much as I love doing what I don't know what the heck I'm trying to say. I get as much out of this as much as I hope I give you guys out of this. By talking to you guys, it helps me clarify and iterate on my thoughts and my narrative. So thank you guys. I appreciate having the opportunity to do this the couple of times per week. Anyway, I wish you all a wonderful day. After party on Discord with the most rational community in the entire crypto space. I love you guys in there each and every day. We do better. If anyone needs me, noahseidman.com. Happy to help you with a one-on-one if you need anything that's outside the scope of Discord or Twitter direct messages. I wish you all a wonderful day. I wish you all a happy Easter, and I will see you guys on Monday. Peace.